If you have any investments or businesses in Hong Kong, then you might be concerned with its linked exchange rate system. On July 14th, the U.S. announced it would revoke several provisions of the United States-Hong Kong Policy Act of 1992. Hong Kong will lose its special status and will face the same tariffs imposed on mainland China. This move further raised the question of whether the peg between the Hong Kong dollar and the U.S. dollar will continue. As discussed in a previous video, Kyle Bass, the founder of Hayman Capital, has been betting that this currency peg will break since last year. In June, he made the same bet with 200-to-1 leverage. So will the U.S. break the peg? How will Hong Kong and Beijing respond? And what will be the likely outcome? The linked exchange rate system. In 1983, Hong Kong experienced a currency crisis partially caused by concerns over the Sino-British negotiations over handing the city back to China, known as the Black Saturday. The Hong Kong dollar dropped to its historic low of 9.3 per US dollar, and stores began accepting US dollars only. To save its financial system, Hong Kong started pegging its currency to the US dollar on October 17, 1983, which is known as the linked exchange rate system. The peg means that the Hong Kong Monetary Authority will buy US dollars with Hong Kong dollars when the US dollar is weak. It will buy Hong Kong dollars with the US dollars when the US dollar is strong. The goal is to have the exchange rate kept between 7.75 to 7.85 Hong Kong dollars per US dollar. The linked exchange rate system has helped maintain the market's confidence in the Hong Kong dollar. And so far, it has survived the 1997 Asian financial crisis and the 2008 financial crisis. But this time is very different. Hong Kong now finds itself caught in the new U.S. China Cold War. Will the U.S. break the peg? According to statistics published by the Pew Research Center on April 21st, about 90% of Americans believe China is a threat, including 62% who believe it to be a major threat. Seeing the Chinese Communist Party as an enemy to the free world has become the consensus between the Democrats and the Republicans. Since the CCP violated the Sino-British Joint Declaration by enforcing its national security laws for Hong Kong, the U.S. has been taking stronger actions against the authoritarian regime. The CCP will not voluntarily give up its power and control over Hong Kong. Therefore, this trend will likely continue regardless of which party will take power in the U.S. after November. The U.S. has an extreme but straightforward option to end the linked exchange rate system by limiting banks' ability to sell U.S. dollars to mainland China and Hong Kong. Kevin Lay is the chief economist for Asia ex-Japan at Daiwa Securities Group Incorporated in Hong Kong. He suggested that a more extreme approach would be cutting Hong Kong from the Society for Worldwide Interbank Financial Communications, used for clearing global transactions. That's a nuclear option. It's unlikely, but not impossible, he said. Without access to the global US dollar pool, the Hong Kong dollar will not be functional. But according to the BBC, there are still 1,300 US companies and 85,000 Americans in Hong Kong. As of 2019, American banks in Hong Kong had $166 billion in assets. The ties are still close. Therefore, it is unlikely that the U.S. will end all of its trade with Hong Kong and ban the Hong Kong dollar all of a sudden. Instead, we shall expect to see a more gradual and targeted approach in weakening the linked exchange rate system. On August 7th, the U.S. announced sanctions on Hong Kong and CCP officials, including Chief Executive Carrie Lam and the head of police. The U.S. might keep enforcing sanctions on specific individuals, companies, financial institutions, and government bodies, and limiting their access to the global transaction clearing system like SWIFT. Building house on the sand. But even if the U.S. doesn't take direct actions against the Hong Kong dollar, the linked exchange rate system's foundation has shifted. In 2015, an IMF working paper concluded that mainland China had a more profound influence over Hong Kong's economy in the long term. But in the short term, Hong Kong's business cycles tend to be better matched with the United States, and therefore pegging its currency to the US dollar seemed appropriate. But many things have happened since 2015, and likely the economic dynamics will not last. The market's confidence in the Hong Kong dollar has been partially derived from the city's high level of openness and compatibility with the Western financial and legal systems. With the new Hong Kong security legislation, the CCP will continue to destroy Hong Kong's rule of law and freedom, making the once semi-autonomous city more similar to mainland China and the Hong Kong dollar more like the Chinese yuan. Also, as Hong Kong loses its special status, its trade volume, and therefore economic ties with the U.S. will likely decline over time. The correlation between Hong Kong and the U.S. economies might decrease dramatically, and Hong Kong will find it harder to follow the U.S. monetary policies, which include raising and lowering interest rates. On the other hand, Hong Kong's economic performance will have an even higher correlation with mainland China. And don't forget that China's economy has already been decoupling from the United States. Those who believe that the U.S. can defeat the CCP will probably transfer their wealth out of Hong Kong. Maybe the Hong Kong dollar can hold onto the peg for a while. Eventually, the foundation of the linked exchange rate system has started shifting beneath it, just like a house built on sand. But will the Hong Kong government and the CCP sit back and watch it happen? How will Beijing and Hong Kong respond? On June 2nd, the Hong Kong Monetary Authority claimed to have over $440 billion in its foreign currency reserve, more than twice the city's monetary base, and enough to defend the linked exchange rate system. On top of that, Hong Kong's financial secretary, Paul Chan Mo-po, claimed that the city has a currency swap arrangement with Beijing. Through the agreement, the People's Bank of China will provide Hong Kong with a quota worth over $57 billion as needed to support the currency peg. It seems Hong Kong will put up a strong defense for its currency, but is that the actual case? The risky and expensive defense. Assuming Hong Kong's foreign reserve is, as reported, twice its monetary base, the question is whether this ratio is meaningful. The monetary base does not represent all the currency in the economy that can be used for transactions, such as buying U.S. dollars. Instead, it might be more relevant to use Hong Kong's monetary supply. Here, we use M2, which represents the amount of currency in the form of cash or can be easily converted to cash. Hong Kong's foreign reserve plus the quota from Beijing is just over a quarter of its M2 money supply of about $1.95 trillion. Therefore, the Hong Kong Monetary Authority might not have enough to defend the dollar peg against a potential rush for the US dollar, combined with short selling by speculators like Kyle Bass. Now the question is, how likely will Beijing provide support beyond the $57 billion? On the surface, $57 billion is just a change of China's $3.1 trillion foreign reserve. But how much of the $3.1 trillion is available for Beijing to use freely? The answer is not a lot. China has over $2 trillion worth of external debt, which will have to be repaid using its foreign currency reserve. The reserve includes around $540 billion of direct foreign investments, which technically belongs to foreign investors. Beijing also needs 2 months' worth of import value set aside in case of an emergency, which is estimated to be $360 billion. Subtracting these numbers leaves only less than $150 billion for Beijing to use freely. This number checks out with the Bloomberg article, which stated that China's minimum foreign reserve requirements amount to about $3 trillion using the International Monetary Fund's criteria. The calculation leaves Beijing with about $100 billion. Keep in mind, the $100 to $150 billion will have to be used to support both the Hong Kong dollar and the Chinese yuan. If the above estimates were accurate, Beijing seems overly generous by pledging over 1/3 of it to Hong Kong. And even if Hong Kong and Beijing have enough reserves, defending the Hong Kong dollar is not without costs. In 1998, Hong Kong successfully defended against George Soros's attempt to attack its currency. But the move resulted in higher interest rates, which caused asset prices to drop. And now that Hong Kong's debt to GDP ratios are way above their 1998 levels, the cost of letting its interest rates rise might be much higher. As Mr. Kevin Lay put it, it's not a question of whether the peg will survive, but a question of at what cost. Although the foundation has started shifting, Beijing and the Hong Kong government are expected to continue supporting the linked exchange rate system to maintain market confidence. But how much faith will the public have in it? Going forward, the Chinese Communist Party has practically thrown away the Sino-British Joint Declaration, As the U.S. China Cold War goes on, tighter controls by the CCP means Hong Kong and its currency will likely decouple from the U.S. at an accelerating speed. Western countries, including the United States, have introduced better immigration opportunities for Hong Kong citizens. Some investors and residents, seeing the trend, are already leaving the once free and prosperous city, causing capital outflow from Hong Kong. As Confucius once said, quote, "A wise one will not enter a tottering state, and will not dwell in a disorganized one." How long do you think the linked exchange rate system will last? Leave your comments below. Thank you for watching Unseen Fortunes. If you enjoyed our content, please click like, subscribe, and share. We'll see you next time.